Greetings from beautiful downtown St. Louis, Missouri. Good afternoon, everyone. My name is Dave Finklang, and on behalf of all of my partners and all of my colleagues here at Anders CPAs and Advisors, we're happy to have you joining us this afternoon. I'll start with a little bit of a running joke here at the firm. For those of you that have joined us before, welcome back. But you might recognize me as your local meteorologist. I like to give a quick weather update, apparently, to some of my colleagues. So I will tell you, looking out the back window here downtown St. Louis, my gosh, it's a beautiful day. It's sun is shining. It's about 60 degrees. So for those in and around St. Louis, hopefully you're enjoying the weather. This webinar, it's taking a little different theme than we maybe originally thought about a month ago when we started planning it. So for those of you, throughout Missouri and throughout the country, the climate that we're living in has changed fairly drastically. The tone on the news, the tone in the newspaper, the tone probably in your business and family discussions is quite a bit different than maybe we were all hoping this time of year. I was looking back through our notes, and the last time we all got together with the big group for one of these webinars was June 11th. Over 5 months ago was the last time that we all got together to have one of these discussions about the PPP program and about the economic impact of the pandemic. Hard to believe 5 months later, we're still talking about the CARES Act and PPP, but very unfortunate that here 5 months later we are talking about the continued spread of the pandemic. So from myself, all of my colleagues and partners, we sure hope you all are doing as best as you can out there, staying safe, staying healthy. We are very well aware that businesses in different industries are struggling, individuals are struggling. So I can tell you that our firm, our COVID-19 team has spent countless hours, many nights, many weekends trying to stay as far ahead of the economic and financial impact of the pandemic. This afternoon, we're really here to talk to you about the culmination of a lot of research and really the culmination of a lot of experience now with the PPP forgiveness application process. That's going to be the focus of this afternoon is really forgiveness and applying for forgiveness. Our approach this afternoon, instead of copying and pasting from the SBA website or from other guidance and just kind of throwing some slides your way, we really hope to share our combined experience with now, quite frankly, countless of PPP forgiveness applications we've been through. We've been able to dissect the rules and really come up with some good planning points and some good opportunities for companies that may have thought they were going to experience a reduction in their forgiveness, but due to some planning, we were able to maneuver all within the confines of the guidelines, able to get them to a favorable spot. So today's focus is forgiveness, sharing our experience. We do have just a really, we're pretty proud to say, impressive list of past webinars and videos and blogs that we've written and had recorded. So if there's any questions on some of the more intimate details of the program other than forgiveness, we certainly invite you to visit our COVID-19 Resource Center. Kind of got it sitting behind me on my screen here just to give you an idea what it looks like. But a lot of resources there and a lot of investment on our firm's part and a lot of my colleagues' parts to really bring all this information to you. So that being said, I'd like to introduce the co-presenters with me today. So a couple familiar faces probably if you've been with us before, and if this is your first time, again, welcome. Myself, partner with the firm, very happy to be on this COVID-19 team with some very dedicated individuals. And my colleagues, Paul, Dan, and Rebecca will be presenting along with me today. Paul and Dan, for those of you that get our news blast, probably recognize the two of them from their weekly PPP with Paul and Dan series. So hopefully that's, as we bring those to you every week, giving you good insights as well. Behind the scenes, my gosh, we've got a whole team of Q&A experts ready to answer your questions as they come up. So my partner Dan and our colleagues Chad and Abigail will be kind of leading the individual Q&A teams, but a number of folks behind there helping them as well. What we've learned through, believe it or not, we've done over 50 of these different webinars, either for a broad group like this or individual associations, is questions come kind of fast and furious at us. So we'll try to answer just as many as we possibly can throughout the day. If we can't get back to you, we'll find a way after the webinar to connect with you, leave us your contact information. The one thing we do ask is if you do have a question and it's pretty specific to your business or you individually, we might not address that today just because we're trying to keep today's more discussion oriented for the broader benefit of the group. But if you do have a very specific question, feel free to provide your contact information and we will get back to you, of course. So with that, let's take a quick look at our agenda, just to let you know the order of operations here. That way, if there's a specific topic you've wanted to hear about or you're thinking about, you'll see if we're going to cover it, see when we're going to cover it. So, if you have a question right now and it looks like we're going to cover it a little bit later down the pipeline, we'd ask that you just kind of wait, make sure you listen to those slides. If you still have a question, then definitely ask that question. So what I've showed a number of times on our next slide is what we call our PPP roadmap. So those of you that have been with us before, you've seen this, and this map just continues to kind of snake its way down. And the reason we like to show this is up in the top corner on March 27th. That's when the CARES Act was signed into law. Way back then, it's hard to believe we're still talking about it, but way back when, March 27th, CARES Act signed into law. And many of you that have been through the process with us have seen all these little stops on the map, and each of those stops has added sometimes clarity, sometimes confusion, sometimes a little bit of both. We'll be the first to admit that, if you watch this map or follow this map, the PPP program certainly hasn't been without its frustrations and its headaches for folks. But we can kind of sit here and tell you that based on the number of businesses we've worked with, either as clients or in the broader business community, it sure seems like the PPP program has done what it was intended. It's helped keep businesses afloat. It's helped keep people employed. It's done exactly what it was intended for. Was it 100% executed perfectly? Maybe, maybe not, but at least it did what it was supposed to. Now we're to the end of the map. We're past October 13th. Most of you are outside of your covered periods. Now it's time to really focus on the forgiveness part of the PPP process. And with the continued pandemic, we wouldn't be surprised, and we'll talk about this a little towards the end, we wouldn't be surprised to see if that map continues to snake a little bit with future programs. So with that said, we're going to jump into our first question. We're going to use our what's been well received by folks as our Q&A format, really talking through some of the most common questions we're encountering from those we're working with. So first question this afternoon is for my colleague Paul. Paul, okay, so I've kind of alluded to the forgiveness process. Are banks actually now accepting forgiveness applications? And if so, can you kind of talk us through some of your experience in this process for banks that aren't open?
Yeah, thanks, Dave. Why the long wait? That's one of the things that was being questioned all along, because the actual website for the SBA that allowed these applications to be input was on August 10th. But a lot of banks waited till as late as a week ago to really start opening up their portals or accepting applications. And they were doing that for a couple different reasons, but probably the biggest reason was that we all expected to see more guidance than we've probably even got, but we expected to see it. And we do expect to see more. When, we don't know. But for banks early on, a lot of those folks were taking hard applications, meaning there wasn't a physical portal out there. So they were a little easier to just, put in the queue and move forward. But the portal-driven banks waited a little bit longer because those are things that they wanted to be very intuitive, and they wanted to make sure that we got as much guidance as we could. So, that's really key from their perspective. So we talk about this in the context of sort of who's the boss. And, I've said this before on webinars, we have the greatest banks in the country in the Midwest. So, they're out there doing all the right things for their clients. But their goals are to make sure that they move through the process correctly and efficiently. And what we want to just make sure that whether it's your advisors, such as your accountant, your attorney, your bank, you're really the boss. And it depends on what you want out of this process as to when you really apply. And many clients have said, we're just not going to do this until next year because we expect more. Or we're not going to use this because we need more time to put all of our appropriate information together, because you really get one shot at this. So we need more time. We'll wait till 2021 to begin a process. And some folks are doing it right away. So how are all these banks accepting the applications? One of the things you need to make sure is that is your bank a portal bank or a non-portal bank? And what I mean by that, if your bank just is requiring, sometimes smaller banks, hard applications, really not driven around an online portal, you're just applying for forgiveness, much like you would apply for a loan with your banker. You're filling out the application, you're putting all the supporting documentation in a packet, delivering it to that banker. The banks that have chose to use an online portal will have it set up where you can go in. There are intuitive questions. You answer those questions. It fills the application out for you. You can download the information. Then it goes directly to them. They take the time they need and then moves on to the SBA. So just because your bank doesn't have a portal doesn't mean that you're going to the back of the line. So one of the big things that it has obviously been a question is, when is the actual date? When am I required to apply? I heard I had to do it by October 31st because there was a date on the application. The actual statute reads that you have 10 months after the last day of your covered period to apply for this loan. Are we suggesting you wait till month 10? I don't think anyone's doing that. But realize that period of time is there for a reason, to give you the time to put the best application together to get forgiveness, because I said earlier, you only get one shot.
Well, thank you, Paul, for kind of walking through our experience thus far. You know, bank application windows, portals are open. So thank you very much, Paul. So next question is for Dan. So Dan has been at our firm one of our go-tos in terms of the preparation and review process of these applications for forgiveness. So Dan, I'm going to kind of tee up a question for you and let you run for a minute here. How do we actually go about starting the process to apply for forgiveness, and what do the application options look like?
Yeah, thanks, Dave. Thanks, Paul, for kicking things off. When you get to the point of wanting to begin your forgiveness application process, one of the first things you need to do is decide which form to use, or which form you're required to use. There are 3 different application forms, all relatively similar with slight differences, but those differences can save you quite a bit of time. The newest and the first application I'll go through here is the form 3508S. It's called the Simplified Applications, that was recently introduced for all PPP loan recipients that have a loan amount of $50,000 or less. You still do need to provide some documentation as it relates to payroll costs or even non-payroll costs. But what you do not need to provide is documentation for FTEs during the reference period or covered period, or any report any salary wage reductions. For those using the simplified application, those borrowers with $50,000 or less loan, you are not subject to any FTE reduction or wage reduction clauses. So there is a little bit of a benefit there, that you don't have to go through some of the documentation and calculations that more or less support the lack of reductions in FTEs or wages. So the big advantage here is you only need to provide documentation, and as long as you spent up to your PPP loan amount, you will get full blanket forgiveness. The next application here is the form 3508EZ. The EZ application isn't particularly easy. It does provide a little less documentation that is required, but you still have to go through quite a bit of the supporting documentation requirements that you need to submit to the bank and ultimately the SBA. So to use the EZ application, you have to really meet one of 3 criteria, and the first criteria is kind of a moot point now, because this was in place before the simplified application was introduced. So I'll skip straight to the second bullet point here under this, and it's, you did not reduce salaries and wages for any employee by more than 25%, and you did not reduce your FTEs from the January 1st, 2020 date through the end of your covered period. So this is where we've kind of come into a hiccup with some clients in the forgiveness applications. They may not have reduced their FTEs from their reference period to the covered period, but they may have reduced FTEs from January 1 through the end of the covered period. And if you did reduce your FTEs from January 1 to the end of the covered period, you are not eligible to use the EZ application unless you meet one of the exceptions, which is, one of the exceptions here is the inability to rehire individuals that were employees on February 15th, or if you offered employees to restore their hours and the employee refused. So those are the only two exceptions here to continue the ability to use the EZ application in this criteria. Then the third criteria to use the EZ applications is you did not reduce salary and wages for any employee by more than 25% during the covered period, and you were not able to maintain the same level of business activity during the covered period due to health directives and guidance from state and local authorities as it relates to COVID. So if you did not meet any of those criteria, everyone else has to use the standard application.
So Dan, before you jump into your next slide to get into some of the, I think, documentation process, one thing that was talked about quite a bit was at some point maybe automatic forgiveness for companies of certain loan amounts. Has anything come down the pipe official, any decisions made on that? Said more directly, are there any companies that are eligible for automatic forgiveness without going through any of these three?
Yeah, that's a good question, Dave. And quite frankly, I was maybe a little cautiously optimistic, a handful of months ago for there to be some level of what I'll call blanket forgiveness. As it stands today, I wouldn't anticipate or expect any additional changes that do allow for more or less sign your name, check a box that you get full forgiveness. I think what we're working with today is probably how we ought to operate moving forward. Okay,
thank you, Dan. You can you can proceed as planned. Didn't mean to interrupt you there.
Nope, all good. Thanks. So next is what documents. After you decide what application form you need to use, what documents do you need to apply? Well, the first part is obviously the application itself, including the certifications that the owners or the borrowers must make. Then the supporting documentation requirements are relatively similar, but slightly different when you look at each of the different application types. But in general, for payroll expenses, you will need to have payroll reports and the payroll tax filings for the covered period. That includes the forms 941, 940, and those payroll tax filings that you have. So those are required to be submitted to the bank with each loan application. Also, you may be required to have payment receipts, canceled checks, or bank account statements that support employer contributions to retirement plans or health insurance plans. That is something that is required for every application. The third bullet point here is FTE documentation. So you will need this FTE documentation for both the EZ application and what I'll call the long application. The FTE documentation requirement is for the covered period. So you have to show FTEs per pay period for the covered period, as well as the reference period that you choose. And Rebecca will touch on that here in a little bit, but so you'll need FTE documentation for the reference period that you choose, as well as the covered period. Lastly, for the EZ application, like I mentioned earlier, if you are going to use the EZ application, you cannot have reduced FTEs from January 1 to the end of the covered period. So the FTE documentation for the EZ application, you will also have to provide FTE documentation as of January 1, 2020 to prove that you did not have a reduction in FTEs from that time. Then for non-payroll costs, you will have to have copies of invoices and proof of payment for all non-payroll costs, rent, utilities, interest, and so forth. You will need to have account statements from, say, your lender or your landlord, but you need to have documentation verifying the proof of the expense and the proof of the payment. So So those are both very important to get full forgiveness. And then you'll also need for certain things such as rent expense or utilities, you will need documentation verifying that that type of expense was in existence prior to COVID or prior to February 15th of 2020. Moving on to one last slide here. What do we need to maintain in your files? Not necessarily submit to the bank, but there are requirements that you must maintain certain documentation in what we'll call your PPP due diligence file. There's a handful of items here listed. I won't go through them all, but in general, what you need is you need a copy of your original loan application and the promissory note. You need a copy of all the supporting documentation that you used to get the loan amount calculation. So when you submitted your loan application to get the funds, you would have had to provide supporting documentation to support that amount. You need that amount. What I will focus on here is on the middle right, a memo discussing your organization's eligibility and reasons why you took a PPP loan. This is most important for borrowers that have a PPP loan of $2 million or more, but it is really required for all PPP loans. But like I said, it's most important for those larger PPP loans that will be looked at in some capacity. So you do want that memo in your file for if and when that time comes that you need to provide all the supporting documentation, whether it be to the bank or the SBA. With that, I'll turn it back to Dave here to move on to some Forgiveness 101.
Excellent. Well, thank you, Dan. Yeah, we're going to give you a few minutes to unwind over there. You've been speaking for a while, so we're gonna turn it over in a second to our colleague Rebecca. And as I alluded to at the beginning of the webinar, any additional details you want that aren't specifically forgiveness related, feel free to visit our COVID-19 Resource Center to watch some of those prior webinars and blogs. That being said, we do want to cover, just as Dan called it, kind of Forgiveness 101, just cover a couple of the basics here, because then that does go into some of the strategy for maximum loan forgiveness. So Rebecca, if you don't mind, first question for you, just a high-level recap of what expenses can be included for PPP loan and for PPP loan forgiveness.
Thanks, Dave. So you took the words out of my mouth. I would encourage anyone who wants more specific details on any of these expenses to check out our COVID-19 Resource Center. We have numerous blogs, PPP with Paul and Dan, and previous webinars that address a lot of this. So my goal today is to go through a lot of these items, and I'm going to hit some key points and then a lot of high-level information. But as I go through, there's a lot of numbers and dates to keep track of. So I invite Dave or Dan or Paul, if I misspeak or if I say something, please catch me, and we will make sure everybody's on the same page. So first of all, very high level, hopefully this is something that everyone is familiar with at this point, but what expenses can I include on my forgiveness application? And we're going to start with payroll costs. That's going to start with taking our gross wages paid to our employees. Then we can add on to that employer paid state and local taxes, employer paid health insurance, employer paid retirement plans. There are some expenses in this bucket that do not qualify, namely employer paid payroll taxes, any unemployment for federal or any FICA taxes. We don't get to include those in payroll costs. Our payroll cost must be at least 60% of the forgiveness amount. So let me give you a real clean example. If my PPP loan was $100,000 and I spent $50,000 on payroll costs, I would only get to include the numbers like $83,000 in my total amount forgiveness, and the difference would be a loan. So we have to have spent at least $60,000 to get full forgiveness. We can also include rent expenses, mortgage interest or interest paid on other secured debt, and utilities. Utilities can include electricity, sewer, water, that type of thing, and there's more specific SBA guidance out there on all of what that includes. So on our next page, getting back to payroll costs, there are a couple maximums to look at. If we are an owner employee or a self-employed individual, our compensation is limited to what we can include in the forgiveness application is limited to 850 seconds or 2450 seconds of 2019 compensation. So that would be if we're using the 8-week covered period versus the 24-week covered period. We take our 2019 compensation divided by 52 weeks times the either 8 or 24. Or the maximum would be $15,385 during the 8-week covered period, or $20,833 for the 24-week covered period. So that would be for any owner, employee, self-employed individual, someone who files a Schedule C or a Schedule E. That would also be a member of an S corporation. Or for general partners, and I'm going to read this quote specifically, general partners are capped by the amount of their 2019 net earnings from self-employment, reduced by claimed Section 179 expense deduction and unreimbursed partnership expenses, multiplied by 92.35%. So if an individual receives a K1 as a general partner, that's how we would calculate their maximum compensation. All other employees who are not owner employees are limited to $15,385 during the 8-week period, or $46,154 during the 24-week period. We'll talk a little bit more later on pros and cons between using the 8-week and the 24-week covered period, but as you can clearly see by the amounts on this slide, there's a lot more opportunity to capture some of those payroll costs just based on the maximums, based on the limitations, by looking at a 24-week covered period. So if we go to our next slide, so now we have a rule about maintaining wage levels or retaining wage levels. Loan forgiveness may be reduced if you decrease salary and wages by more than 25% for any employee compared to the first quarter of the year. So we have to look at this at an employee by employee basis. We'll compare the wages that they made during the first quarter of the year to the wages that they made during the covered period. If the amount that they were paid during the covered period was reduced more than 25%, we may be subject to a reduction. Our second caveat here, if we do determine that somebody's wages were reduced more than 25%, then we get this look back option. We can look back to 2019. If the employee was paid more than $100,000 annualized in any period during 2019, we don't have to consider them in this reduction clause. So for example, if an employee was paid a bonus in the last couple weeks of the year of 2019, and that amount annualized makes them over 100,000, even though for the full year they weren't paid more than 100,000, then we would not include them in this wage reduction calculation.
So Rebecca, I wanted to jump in really quick on that point that you just made. So at the beginning of the webinar, I made mention that our goal today was to really share some practical tips and tricks and expertise from a lot of these applications. This is one of those points that when the CARES Act first came out and PPP first came out, that I don't know that people necessarily glossed over, but nobody really thought was going to be that instrumental in forgiveness. And it can tell you that this one last point here has helped a lot of companies that we've worked with achieve full forgiveness by way of, unfortunately, some companies that have not been able to maintain the full wage level. We did look back at those individual employees and found a number that this one exception applied to, specific to a year-end bonus in 2019 that put somebody over an annualized 100, even though they weren't paid 100. So this is a point that originally kind of got glossed over, but if you're running up against the wage reduction, we would definitely encourage you to focus on this one point to see if a bonus last year put that particular employee over an annualized 100,000. I just thought that was such a key point, and we've seen it work for so many clients so far that we wanted to really drive that home. So Rebecca, I'll hand it back over to you, of course, but just wanted to kind of drive that point home.
Thanks, Dave. And I think that's a great point when we're looking at doing all that we can to maximize our loan forgiveness. So if we move on to the next page, we're going to talk about full-time equivalents. So our full-time equivalents are calculated on a weekly basis. If an employee works 40 hours or more during a week, they count as a 1 FTE. If they work under 40 hours in a given week, then they are considered either a 0.5 FTE, or we can take their the number of hours divided by 40. So for example, if we have an employee who worked 32 hours in a week, we would either consider them a 0.8 FTE or a 0.5 FTE. Either way that we do it is fine. One may be more advantageous than the other, but we need to keep it consistent how we're calculating during both the covered period and the reference period. So our reference periods here, we can compare the amount during the covered period to either February 15, 2019 to June 30, 2019, or January through February 2020. We get to choose either one, whichever one has lower FTEs. There's no SBA specific requirement on which one we are required to use. So if we go to the next slide. So what if I am unable to, what if my wages per employee or my FTEs were reduced? Am I out of luck? Is there anything that I can do? There's 2 safe harbors that we can look at. The first safe harbor just applies to reduction in FTEs for borrowers that are unable to return to the same level of business activity prior to February 15th due to compliance with requirements or guidance issued by local and state government between March 1st and December 31st. So that's essentially saying, you know, I haven't been able to open my restaurant back to its full capacity, or I haven't been able to open my retail store back to its full capacity due to guidance, that we don't have to consider FTE reductions in those cases. As Dan mentioned earlier in our due diligence file, I would say it's important to make sure that we have note of what these rules were so that we can show that we weren't able to be open like we normally would be, like we were on February 15th. That's why we qualify for that clause. The second safe harbor, if the borrower reduced its FTEs or wage salary levels in the period between February 15th and April 26th, which is 30 days after the initiation of the CARES Act, the borrower, if they restore FTEs or those wage and salary levels no later than December 31st to what they were on February 15th, we qualify for that second safe harbor exemption. It's important to note that maybe you fit for safe harbor number 2 for FTEs, but not for your wage and salary levels. They're not mutually exclusive. You have to qualify for each one separately. If you don't, then you know, we might need to be looking at some of those reductions. So after sharing all of that fun bit of information, I'm going to pass it back to Dave so that we can look at some more.
Thank you, Rebecca. And you know, as I mentioned on one of your prior slides, you know, these are the slides where we're finding the best planning opportunities for companies that on the surface thought they were going to have reduced forgiveness. And these are some of the points that when you dig into them and you really, you know, for lack of a better term, kind of slice and dice them, you can come up with some ways to get back to full forgiveness or closer to full forgiveness. So Dan, I'm going to turn things back over to you with a question. So Rebecca talked through these safe harbors, one applying to wages and full-time equivalents, one just to full-time equivalents. From a full-time equivalent standpoint, if we don't fall into either of these safe harbors, are there any other ways that we can still achieve full forgiveness or maximum forgiveness?
Yes, certainly. And in addition to the safe harbors that Rebecca just discussed, there's a handful of additional caveats or outs that we can utilize that will help us obtain full forgiveness. For example, there was just the most recent PPP application I've looked at had about a 15 or so, had a reduction in FTEs of about 15 people or so, which kind of caught our eye to a certain extent. But as we began going through and looking at these FTE numbers, we actually had a number of exceptions that would likely allow for full forgiveness. And some of these, they're all listed here, but if the borrower made a good faith effort and a written offer to rehire an employee, which the employee said no to, you're not going to get dinged for that as the borrower. If you fired someone for cause, that will also not impact your ability to get full forgiveness. Now, you do want to get supporting documentation in your file for all of these reasons, but if someone voluntarily resigned, and for example, in the most recent one I was just referencing, there was a number of retirements within this company. So you are not dinged for employees who retire or voluntarily resign. You're also not impacted by those who voluntarily requested and received a reduction of hours. You're not impacted by borrowers who made a good faith effort and written offer to restore a reduction in hours, and the employer rejected that. And then lastly, similar to what Rebecca was alluding to earlier, was if a borrower is unable to hire a similarly qualified employee for unfilled positions by December 31st, that is also an exception to the rule. Now, these FTE reductions, all of these FTE reductions will not reduce the borrower's forgiveness amount. And in fact, some of these, the first bullet point here and then the last two bullet points will actually provide an exception for borrowers to continue to use the EZ application. So if someone was fired for cause, voluntarily resigned, or had a voluntary reduction in hours, that would create the need for the long application, whereas the other exceptions here would still allow for the EZ application.
So Dan, I think now's a good point that I'd like to, if we circle way back to when we first started talking about PPP in April and May, on a lot of those early webinars, we started getting a lot of questions about kind of all these scenarios. And at the time, there was no clear SBA guidance in terms of, what if we had to fire somebody? What if somebody resigned? What if somebody retired? So at the time back in, May, June, it was thought that there really wasn't going to be a way out of those situations. So for folks that haven't been tracking this as closely as we have, really want to drive home the importance of this slide, that if you've asked those questions before in any of these scenarios, definitely take note on this slide, because this slide for a number of PPP applications or forgiveness applications has really been the, for lack of a better term, the get out of jail free card for a lot of companies to get back to maximum forgiveness or near maximum forgiveness if one of these scenarios applied. So again, another point or another slide really we're driving home that we have found has helped a lot of businesses.
And lastly, real quick on this slide, to put this into application, when you're filling out the 3508 or the 3508 EZ and you're supporting documentation, if any of these exceptions are met, they get in that certain employee gets included as one FTE or whatever FTE they previously were. So you really get to add them as an FTE as opposed to reducing your reference period FTEs. Moving on to the next slide here, as it relates to maximizing forgiveness, when should you apply? That's a very common question we're getting right now. We're getting a little bit more clarity on that, but there's still a little bit of ambiguity that allows for maybe a little more time to pass before you actually submit. So unless a borrower qualifies for full forgiveness with almost near certainty, then you may want to consider waiting until a little bit more dust settles or further guidance is issued. Now that the election is more or less behind us, there might be a new effort to clarify and issue further guidance on some of this. But if you are certain to get, or more or less certain to get full forgiveness, I don't see why you should wait any longer. Borrowers, for borrowers that are using the 24-week covered period and have used all of their funds, but they're still within their 24-week covered period, and they have maintained FTE and salary or wage requirements, you may want to apply now rather than waiting to the end of your covered period if you expect FTEs to drop in the latter part of your 24 weeks. And then if you have a drop in FTEs, kind of the safe harbor number 2 that Rebecca had gone through, if you had a drop in FTEs from February 15th through April 26th, but restored your FTE levels now, you may want to file for forgiveness now rather than waiting, say, until late December if you're expecting FTE levels to reduce even further. So you'll want to use that safe harbor number 2 in the event you had a reduction in FTEs or salary and wages from February 15th through April 26th, and then restored those levels prior to year end, at any point prior to year end. Moving to one more slide here, what is our optimal loan strategy? It's no one size fits all here. Each situation is client specific and should be looked at independently of one another. Should you use the 8-week or 24-week covered period? There's a number of things that you want to consider. Payroll cost. Have you used your PPP loan amount exclusively on payroll costs to cover your full forgiveness amount? If so, you may want, and assuming you maintained FTE levels, you may want to opt for the full 24-week covered period because it's going to provide, or it'll provide a lot more ease in terms of supporting documentation. If you only have to obtain and submit payroll documentation, that'll make everyone's lives a lot easier rather than having to gather and accumulate all the non-payroll documentation that would be required. Are you on pace to have the right amount of FTE levels during the 8-week period, or are you going to maintain those FTE levels for the full 24-week period? If you're going to maintain for both the 8-week and the 24-week period, it likely doesn't matter which covered period you choose. But if you are going to have a reduction in FTEs after 8 weeks, but maintained your FTEs during the 8 weeks, you may be more advantageous to use the 8-week covered period. And then are you planning to utilize any of the exceptions we previously talked about? So these are all just things that you'll want to consider before deciding when to apply, what covered period to use, and things of that nature. So there's a little bit of strategy that can be in play, and I just really want to think outside the box to make sure you're doing everything you can to get that full forgiveness.
All right, thank you, Dan. So as we pointed out on a number of slides, there's just some good nuggets in the PPP program to find our way towards maximum forgiveness, as well as Dan alluded on this last slide, some timing to what you pick and when you apply. So thanks, Dan, for walking us through all those. Now we're going to turn things back over to Paul. So Paul spoke a little bit at the beginning, and I know what y'all were probably thinking. Paul got to talk on one slide and he got to go home for the day. No, we're actually going to make Paul work for his paycheck today. So, Paul, we're going to bring it back to you. A couple of things have come up over the past month or two from the SBA that have definitely raised some eyebrows and some concern for folks. One are these questionnaire forms that the SBA has been sending out on the larger loans. Can you please talk us through what these questionnaire forms are and kind of what our experience with them has been so far, what folks should be looking out for? Kind of run them down, these questionnaire forms, if you don't mind.
You're on mute, Paul.
I'm on mute. So, one of the things you see in there is the bolded text that says in excess of $2 million. So for those of you that are under 2 million, don't check out on me. Don't go to the restroom or get something to drink, because at the end of this, I'm going to unfortunately pull you back into this thing. So as Dave mentioned, about 3 weeks ago, kind of quietly, the SBA started sending out questionnaires to borrowers in excess of $2 million or more on their PPP loans. Form 3509 was for-profit businesses. Form 3510 was not-for-profit businesses. And kind of the question is, where did this come from? So if you remember in the very beginning, all of the challenges around, do I really qualify this? Do I not qualify for this? Well, the SBA and the Treasury made a promise to Congress that they would review loans $2 million and over. So this is that first shot. And this is in certainly the way the SBA has done business in the past. They release questionnaires on any loan portfolio to determine if they need to take a deeper dive. So what we really feel like is this is their opportunity to gather the information, get the questions answered, and then depending on how you answer those questions, and I know that's a terrifying thought, it doesn't mean that they're trying to catch you in anything, but there's a list of questions, and if you answer them a certain way, obviously you're going to answer them truthfully, but if they fall in certain patterns, then they might require a deeper dive. So let me give you a perfect example. Let's say you answered question 1 that had to do with how you paid owners. Did you pay owners large distributions during the covered period? And in conjunction with that, then how did your profit look in your covered period this year in the first quarter versus the second quarter, and then second quarter 2019? In and of itself, there are a lot of companies, because so much stimulus money was running through, that made more money in the second quarter this year, even in a pandemic, than they did in the first quarter. That in and of itself isn't a flag in any way, shape, or form. But combined with the question that might answer, we paid excessive dividends, using my terms, not theirs, and then another question that will ask about capital expenditures. You know, did you do some things with your business during the covered period, such as capital improvements? You start answering all of those questions, you can see what they're looking for. They're looking for an opportunity really to dig down, to see if they need to take a deeper dive. So I think one of the things that is important is to understand that the questionnaire asks 2 things. It really asks about your business assessment. How was it affected by the pandemic? You know, how did you handle your cash during the pandemic? How did you pay your employees during the pandemic? And then it rolls into a liquidity assessment piece of it. And it really wants to know, how much money did you have on hand? Again, someone has a couple $1 million in the bank that is using that for normal operating expenses. In and of itself isn't, the SBA didn't anticipate that people would completely run out of money before they would apply. That's not their goal. But when they ask those 2 styles of questions, they're certainly wanting to move forward. So the last thing I would say is to kind of pull everyone back into this. You remember, this is $2 million and above. But if you also remember, quietly, the SBA said we reserve the right to review any PPP loan. So they reserve that right, and take it from someone who's worked with the SBA for many, many years. When they say something, eventually they will get back to that. So a good practice is, if you had a loan that's even $1 million, get your hands on one of these questionnaires. And by the way, this is so new, it's not even out on the SBA website. They're just being sent to a few customers. But get your hands on one of those, and we'll have those posted to our website. And sort of just do your own test. Keep it in your file, do your own test before you're asked. Because once that questionnaire comes to the bank, it will be administered by the bank to you. You have only 10 days to answer. So not a bad idea to do a practice one, keep it in file so that if you're asked later on down the road, but certainly work in conjunction with your advisors, because there is supporting documentation that goes along with that. So Dave, I'm going to touch base on something else that was somewhat new, recent, 45 days ago. One of the things that people were running into, making a decision, do I want to sell my business? It's been tough. Time to get out, or do I want to buy a business? Great opportunity to buy a business. I want to be in the market. If you read the documents, the loan documents close, which I know these things were piling at people 100 miles an hour, so there was just a lot of things that were signed that the clients didn't read as deeply as they probably ought to have. Well, one of the things in there was change of ownership. So the answer early on was, can I sell my business? Can I buy a business? And the only answer was no, based on the loan documents. It was going to put a kink in a lot of things. So as it has been so much the case since the beginning, a few people started to get concerned, started to question it. The SBA came out with some clarity. So the clarity basically says, we're going to classify your change of ownership on a stock sale if you're 20% or more, on an asset sale if you're 50% or more, or if you've merged with another company. If those all apply, you really can't sell your business or buy a business that you want, because the owner, if they have a PPP loan, they can't sell their business. but they came up with a couple of things that will help you through the process if it's something you really want to do, and that's create escrow accounts. So when is the SBA approval really required? Well, it's required if the transaction's more than 50% on both sides, whether it's a stock sale or an asset sale, the SBA is going to need to be involved in that. But if not, your bank can really make that decision for you by getting all the information, opening an escrow account. But guess what? You got to put the amount of the PPP loan in that escrow account, and you can't do anything with it until the business is sold, and then it has to pay off the PPP loan at that time. So it does give you a little bit of flexibility. But it's just not the answer I think that everyone was expecting. So what is the borrower required to do prior to sale? If you're going to go through with it, you're going to figure out how to get the cash to put in escrow. Before you move forward and do anything, the bank has to be made aware of everything that's involved in this transaction. Number one, that you've made the decision to sell, the buy-sell agreement, all of the documentation that are involved in this sale of your business. Then the bank has to be made aware of that, because there are situations that they may have to get the SBA approval. So you want to make sure they're aware of it. All of your other advisors are aware of it, and there's a way to get it done, but it's just not as easy as we would like for it to be.
I thank you, Paul, and you're 100% correct. So, mentioned at the very beginning of the webinar just how long we've all been living the pandemic and living the economics and the finances of this all. One of the things that was probably not contemplated well when they expanded from an 8-week to a 24-week covered period is that in the natural life cycle of a business, pandemic year or not, there would be businesses that are sold and get bought. So this was something that was kind of relatively recently put into place to try to help businesses sell in this time. But we've helped a few businesses go through the process. And certainly one of the biggest headaches is you think you're going to sell your business, you think you're going to retire right off from the sunset, and you've got to put all this money into escrow until things get forgiven. So point on this slide being from our experience is if you're contemplating the sale of your business, make sure you're talking with your banker to make sure you check all the right boxes and don't get yourself hung out to dry on potentially having to repay the whole loan. So thanks, Paul, for hitting those. And one thing very interesting that we've talked about internally, you and I and the whole team on the prior slide, in terms of that questionnaire, is, it's kind of unfortunate now that the SBA is looking in reverse and saying, well, if your business wasn't as adversely impacted by COVID as you thought, now we're going to try to get you. What kind of an unfortunate thing for the SBA to say when back in March, April, people had no clue how they were going to make their next dollar, how they were going to pay their employees, how they're going to feed their families. So impossible to predict in March or April what any one business was going to be impacted by. So kind of unfortunate the SBA is trying to somewhat gotcha now. So that's why with that questionnaire, if you do receive one, make sure you're careful on how you answer it. But then to Dan Schindler's point early on, having that internal memo that really dates back to the beginning of the pandemic and why you thought you're going to be impacted, whether or not you were impacted or not, or as adversely impacted as the SBA might think you should have been, make sure to have that memo that really documents why it was necessary for you to have that PPP loan. So we're getting towards the end here. One really important question and talk about changes. This notice from the IRS just came out kind of late in the day yesterday and impacts the taxability or the tax impact overall of PPP loans and PPP forgiveness. So Dan Schindler, I'm going to hand it back over to you. Can you talk us through, general taxability of the PPP loan, and then, what changed or didn't change yesterday with the IRS notice?
Yeah, certainly. And one of the biggest topics that at least we've been discussing as a firm lately has been, what will the tax impact of the PPP loan forgiveness amount be? The CARES Act legislation specifically said the loan forgiveness amount will be excluded from your gross income. But the IRS subsequently, a handful of months ago now, came out with a notice that said, it may not be income, but all the expenses you used for the PPP forgiveness are now going to be non-deductible, which in effect creates a little bit of taxable income, much to the dismay of all borrowers here, because I think the original intent of the CARES Act was to have a no tax impact to any of the borrowers. Last night, at least I saw it, probably 6 or 7 o'clock last night, the IRS issued a Revenue Ruling 2020-27 and Revenue Procedure 2020-51. In general, what that said is it affirmed that what the IRS had previously said, that the expenses are non-deductible if you get forgiveness. Now, what was previously unclear was when would those expenses be non-deductible, in 2020 or in 2021? Forgiveness is likely not to happen for most borrowers until 2021. The revenue ruling said, it gave 2 examples. The first example being the borrower had submitted their loan forgiveness application, say in November of 2020, however, did not necessarily receive that forgiveness until 2021. This ruling still says the expenses are non-deductible in 2020. Further, it said in the other example, if a borrower has not submitted their application for forgiveness at the end of 2020, but expects to submit their application for forgiveness in 2021, those expenses are still non-deductible in 2020. So very disappointing, I think, for most borrowers, and especially us as practitioners advocating on behalf of our clients. But the news here could only be reversed by an act of Congress, which I was talking to Paul yesterday, and he said, you never know, on January 21st, when the new Treasury Secretary comes in, do they act on this then and overrule what the IRS is saying? To be determined, but as of right now, I think, unfortunately, we need to prepare for the expenses to be non-deductible in 2020.
Well, Dan, sorry to have picked on you to make you answer that question, because yes, certainly, yesterday we were all as practitioners very shocked by the IRS guidance that came out. I promised my colleagues, and I'll adhere to my promise, that I would bite my tongue in terms of my opinion on the matter here. But certainly a much different impact come year-end planning time than we anticipated. The one glimmer of hope, if any, is Congress promised numerous times after the summer recess, after the fall recess, to fix this. They have yet to, but it is the intent of the CARES Act for this to be fully non-taxable. The hope being that now that we're post-election and once kind of everybody's in their new seat come January, that we'll see a resurgence in terms of the Congress wanting to fix this. But as of right now, with this most recent IRS notice, we should probably, I hate to even say it, kind of plan for the worst in terms of the tax impact and hope for the best. So,
yeah, one thing I will say, sorry to interrupt, David. One last thing I will say on this is, with the change in likely change in administration coming here, borrowers may want to consider extending their tax return that would originally be due on March 15th to see if Congress does come together, early, mid, or even late next year that reverses this ruling that the IRS is issuing. So could be something that is advantageous, may not be, but something to consider.
Dan, that's a really good point. Extending tax returns not only buys you more time to get everything together after a very crazy year, but it could, in fact, give Congress some time to work in our favor here. So we're right at the end of our time. Paul, I'm going to jump, I think, one slide ahead here. You've been following kind of what's going on in Washington and are probably the best at the firm to speak about what comes next. What are we expecting, or what do we have hope for? So, Paul, can you kind of talk us through that as we wind down here for the afternoon?
Sure, you bet, Dave. Early on, and even up till about a month ago, I was feeling pretty good about myself. I was probably 10 for 10 on prognosticating things, and all of a sudden I seem like I'm about 0 for 5 here lately, because there's some things that are happening that just don't make a lot of sense. I'm going to end up losing my window office if I'm not careful. But there is $110 to $120 billion still left out there in the PPP program. It's been allocated. So it's hard for most of us in the advisory business to think anything other than there will be a second round, but there's no guarantees. We think that if there is a second round, it's going to be very targeted. It's probably after the new administration comes in. And, we'll just have to wait and see. the next round of stimulus, I think the same thing. A new administration is going to have to make a good impression, and you know the administration that's going in is very stimulus friendly. So we think there will be some things that will be positive after that. But there's a little bit of time we got to get through from a pain perspective between now and then. But I still can't help but believe that there's more help on the horizon. We're just sort of caught in a little bit of a lame duck session right now. So that's probably the best I can do, Dave, at keeping my average at least somewhat respectable.
All right, Paul. Well, thank you very much for that. And I think we're all hopeful, not just at the firm, but just in general, kind of in the economic and financial world, that with the new administration settling in, new Congress settling in, that we'll hopefully see something next year. So let's keep those fingers crossed. You know, as we mentioned early on in the program, is, you know, we understand and we're living the struggles with you in terms of business owners and employees. So, you know, we certainly hope something comes down the pipe in early January, especially as we're starting to see cities and states and counties put more restrictions in that are certainly going to harm certain businesses in certain sectors. So with that, we're right at our hour. Again, thank you everyone for joining us this afternoon. Hopefully added some value to what you're trying to accomplish in your business, especially on the PPP front. As I mentioned early on, please feel free here with our contact information. Reach out if there's any questions that come to light, you know, after today, or that maybe a slide spurred a question, or, you know, as you get down the road working on your application. We are certainly here to help in any way we can. We've invested a lot of time in this and are certainly here to share our expertise. You can always visit our COVID-19 Resource Center. Again, you can kind of see it over my shoulder here. And I would be remiss if I didn't mention that, you know, as a firm, we've kind of pivoted. We're still offering a lot of the same services prior pandemic, but now we have an entire team that's really our business recovery services team to help businesses through this tough economic time. So would invite you to visit that part of our website as well. And with that, on behalf of all of us on the COVID-19 team, our entire firm, thanks so much for joining us this afternoon. Enjoy the beautiful weather out there if you're in St. Louis, and until next time, be safe out there.